Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by foundersuite.com. Today I have Brent Pearson of Enboarder coming to us from Washington, D.C., but as you'll tell from his accent in a moment, he's not an American. Brent, how's your day going?
So far, so good. Thanks for that, Nathan. Thanks for having me.
Thanks for being here. So you actually come from Sydney, but you're over here in the States. Are you fundraising or doing customer visits, or what are you doing?
It's a number of things, actually. So I'm visiting customers that we've already signed up. I'm selling and visiting prospects, and I'm also having meetings with VCs, just to sort of line a few up for the next round.
Very cool. Well, you're actually my second Australian CEO this week. And
oh, wow.
Yeah, we did one a couple of days ago with guys who are doing drones for mapping underground tunnels. So
wow,
we'll have to have like Australian week and just feature you guys maybe back to back. So what is Enboarder? Why don't you just give us a little overview of what you guys do?
Sure. So we're a B2B SaaS company, and we build a product which is an HR product, and it's designed for companies that are hiring new employees, and it's to ensure that when they join a company, when you find the talent that you want, that every person that joins your company has a consistent and an amazing experience. So I guess what makes us a bit different from a lot of the other sort of onboarding products out there is a lot of the other onboarding products focus on trying to make HR's life easier by filling in, my tax forms and my I-9 and all that type of stuff. We focus more on the employee experience. So our goal is we want to make sure that every person that gets hired by a company has an incredible first impression of that company and a great start to the company.
Yeah, makes sense. Great. And how long have you been around?
We started in July of 2015, so we're almost 3.5 years old.
And of course, I have to ask, why is it called Enboarder and not Onboarder?
The Enboarder stands for engaging onboarding.
Okay, got it. It wasn't just because the domain was taken.
Well, that too. But we actually, if you're talking about war stories or the most challenging parts of a startup, I think trying to find a name and a domain name would have to be up there as one of the most frustrating 3 days of my life.
Yeah, for sure. You see people get pretty creative with all the different adding the prefix get or adding the crazy top level domains and stuff like that. So
yep.
And where did this idea come from? Were you in HR or what were you doing before this?
So my background is in HR tech. I've spent probably 20 years working in both the US and Australia. I came up with the idea, and I'd had some pretty kind of bizarre experiences in my last 3 startups beforehand. And so I kind of felt like, it was time for me to do my own thing and sort of put my money where my mouth was, number one. And then, I just came up with the idea after looking at some academic research that was done on the topic. And when I read this research paper that was published, which really basically was an experiment around changing the way you brought people into the organization and seeing whether it made an impact on business metrics, I just had this aha moment. It was one of those aha moments, and I thought I had a solution for how to fix it, and that was the beginning.
It makes a lot of intuitive sense. I haven't had a real job in 2 decades or so, but I remember when I was on, the career track versus the founder track, you'd spend all this emotional effort getting the job and hustling to get the job and going through interview. And then you'd start the job, and sometimes it'd be kind of like a letdown, I guess, in some ways, right? It's kind of like, yeah, I remember my first job when I got a job on Wall Street. I won't name the firm, but kind of coming in and and there was really no one to like greet me or orient me, and the chair had a tear on it and just things like that. There was like, that first impression was like, oh, what did I just do?
Yeah.
Yeah.
Totally. And you know, what's more interesting is when you think about it, in the US, the average cost to hire a white collar role is about $2,500, right? And that's if the company's doing it themselves and they're not using a recruiter. So you're spending all of this money to go out there and find the best talent for your organization, and you do only get one chance to make a great first impression. And if you don't make that first impression, you know, I've heard plenty of stories where people have literally resigned in the first week because they felt that they were sold a dud during the recruitment process.
Yeah, sure. So other than just creating a good first impression, what does it sort of, you know, ultimately do, or what does the outcome of using your product?
Well, so yes, there's the sort of the warm, fuzzy satisfaction that you get as a new employee, but we're also coaching and guiding the hiring manager. So we're making that hiring manager look like a rock star, and we're making, you know, making the connection between those two stakeholders better. But in terms of hard business benefits, you know, typically we reduce year one staff turnover. We increase customer satisfaction if they're in a customer facing role. And we also increase productivity and you know, time to productivity.
Okay, gotcha. And is it sold on a SaaS model or a per employee or per hire model, or what?
It's a SaaS model, and it's based on our product. Even though we talk about a position as onboarding, it can be used for multiple different things. So we can create different types of workflow. You can use it for offboarding. You can use it for creating an engaging parental leave when someone goes off. So we basically charge it based on how many workflows you're running.
So let's talk about fundraising. How much have you guys raised, and over how many rounds?
We've raised about $7 million to date, and it's over 3 rounds. So the first part of our fundraising was friends and family, and it was my brother-in-law, my chairman, and myself. We funded the company during the early days, and then probably about 14, 16 months in, our product was live. We had our probably first 8 or 10 customers. That's when we went out for a seed round with an Australian VC called our Innovation Fund. And we raised a couple of $1 million from them to really now accelerate our sales and marketing growth. And then what we've done with them is we've sort of done a couple more bridge rounds on the back of that to take us where we are now. So we've kind of raised capital in small chunks rather than going after, you know, rather than overcapitalizing at the point of growth.
Okay, I want to unpack a couple parts there. I think there's some interesting things there. So let's start maybe with the friends and family. You're raising from your brother-in-law. Was that, there's always this sort of joke about raising from family members that, you know, your next holiday is going to be awkward if, do you have any concern about that, or do you guys have a relationship?
I think I wasn't too concerned about it. So, you know, I put all of the original funding in and sort of really got the company going. And I don't think I would have gone to my friends or family if I wasn't pretty confident about the product and about the value proposition and about the company's product prospects. So I felt pretty comfortable that this, you know, in my mind, this wasn't a super long shot. I think they say that the probability is like 6% of startups succeeding. I didn't feel this was a 6% shot. I kind of felt this was about a 75% likelihood of success. And so from that perspective, no, I didn't really have a problem. I kind of backed myself from the beginning. And you know, I started with small investments from each of them, and they could see the progress that we were making. So they didn't start investing more money until they were comfortable that we were hitting our milestones.
Mm-hmm. Yeah, that makes sense. That's probably a good approach to doing it. All right, and then the that first seed fund from our Innovation Fund. Tell us about raising money in Australia. What's the environment like? You know, are there a lot of funds there, or what's the lay of the land?
Yeah, so it's interesting. The Australian government has recently made some tax changes to actually incent investors to invest in early stage funds or companies. And so what you're starting to see is more and more funds being created specifically for funding early stage companies. And what was interesting is, so my chairman actually introduced me to our innovation fund, or in fact the parent company, and we went to speak to them more just to get their advice about how we should raise funds. We didn't actually know that they had a fund, and so we set up the meeting, and it wasn't actually a formal pitch even. It was just, you know, hey, here's who we are, here's the product, this is what we're looking to do, we're looking to raise money. And then they turned around and they said, we have just put together, you know, a $50 million fund to really help early stage companies, and we love you and we'd love to invest in you. And for me, the fact that my chairman had a personal relationship with these guys and really trusted them and really knew them, that counted for a lot. So we didn't go and we didn't sort of shop this. We didn't go around and, you know, create the competitive tension or do anything like that. They, these guys gave us a fair valuation, and just culturally, I felt very, very comfortable with them. I felt that they were going to be the people that I could trust, and the people that would actually mentor us through the next stage of our growth. And so, you know, perhaps I could have gone out and got, you know, better valuation or better terms, but I was very happy with the relationship I had with these guys, and also just with their counsel and their guidance. So that was kind of the way we secured our first external funding. And you know, one interesting story, I haven't raised external funding before, and so for me, I was in the you know, uncharted territory. And I remember mentally, I kind of thought, I'm going to now have to create a really aggressive business plan and show them amazing growth, blah, blah, blah. And after we had signed the deal and the funds were in my account, I still remember one of the principals from that fund. He pulled me aside. We're having some drinks to sort of celebrate. And he said, Brent, he said, I just want to give you words of advice. He said, you know, you've now got the money in your account. He said, but don't piss it away. He said, don't go and hire salespeople too fast, or don't try and grow too fast, because he said, you're just going to be wasting your capital. He said, start hiring them, but make sure you absolutely know how to sell the product and you can get into the markets you want. And number two, make sure you know how to onboard those customers in a scalable, repetitive way. And he said, only then start to sort of put the accelerator down.
That's good advice, I think. And it feels a little bit maybe as a difference between maybe Australian mindset and maybe Silicon Valley VCs. A lot of VCs, their mindset is, here's the money, do everything you can to get to the next funding, right? Spend it as fast as possible so you get to the next funding round, where this is a little more of a, not a bootstrap mentality exactly, but kind of a you know, grow by selling, right? So, yeah. Do you think that's an Australian trait?
Yeah, no, it's interesting. I think it's definitely a non-Silicon Valley trait for sure. Even in the US, I've noticed a difference between the investors that I speak to in, say, New York and LA compared to the Valley. You know, in the Valley, it is almost the opposite. It's like, how much are you looking to raise? Okay, no, I think you need more than that, and I think we need to grow faster and a winner take all, blah blah blah. So they tend to, you know, they're like, they want to throw money at you, but they want you to go, you know, really hard and really fast. I think it is probably maybe a more cautious or a more patient approach, or maybe just a slightly cautious approach that they have.
Yeah. Do you have any sense of how many venture firms are in, for example, Sydney? Are there 20 or are there 200 or 2,000?
I think it's probably in the, you know, the 20 to 50 would be my sense of, you know, pretty serious sort of ones there. So there's a reasonable amount, but it's certainly not like it is in the US.
And yeah, no, that makes sense. And with the Australian incentives the government is putting out there, is there any action item that founders in Australia can leverage there, or is it more just government things are creating more of a better environment? Is there any like action item a founder can take based on that?
Well, you know, there are some great, you know, the government seems to be doing a lot to really encourage. So everything from, they just changed the tax system to make stock options tax advantageous to companies. Before that, companies couldn't create employee stock option plans. They've made it easier for investors to invest. They've got great R&D grants. They've got great export marketing grants. So there are a lot of good government incentives. And I think that any founder, part of what they should be doing in the early days is meeting with representatives from the government development groups to actually understand what is available and just know what tools, what loans, what incentives you can jump onto.
Yeah, good. So I want to touch on something you mentioned about doing multiple bridge rounds. This is maybe a bit of a also contrarian or different approach than what you hear a lot. And over here you raise your seed, then a big Series A, and then but it sounds like you're kind of raising in stages or tranches. Can you maybe talk us through how that works, what you did?
Yeah, so when we raised our first seed round, that sort of was enough for us to get the next 12, 18 months, and we knew that, and that was the plan. Once we got to that next round, then again, we didn't go out and shop it. We went back to our original investors, and they said, no, we want to back you again. We really love you. You're hitting your goals, you're hitting your targets. So that then sort of gave us a bit more runway. What was interesting is we kind of then thought, okay, our next round, we want to go to the US market and we want to sort of do a Series A. And so earlier this year, I went around and I started talking to US investors, and that was kind of a little bit eye-opening for me. And it was certainly a whole bunch of learning happened. And we actually kind of, you asked earlier for war stories. We actually had a bit of a war story earlier this year. So I went and spoke to a bunch of investors, and the first thing I learned is, man, people tend to put themselves into little boxes. I felt like Goldilocks for the first one I spoke to. It's like, no, you're too late. And the other one is like, no, you're too early. And no, you don't have enough US revenue. And, so I had to sort of try and work out and learn which investors were going to, first of all, just be a fit from a investment profile perspective. But then I realized that even the ones that, write checks the same size that we're after and things like that, there's a lot of different types of investors out there. So for me, it's been a really big education exercise to understand what type of investor they are. We actually signed a term sheet from an investor, and we thought that they were a really good fit for us, and they thought we were a good fit for them. Now, at the time we signed the term sheet, we kind of had like about 5 or 6 months of cash in the bank. We started going through a due diligence process, and we were expecting a due diligence process to take somewhere in the 4 to 8 weeks type time frame, and but it just started dragging, and I don't know if this was by design or whether they were seeing things that caused concern or whatever, but all of a sudden this is now going multiple months, and we were starting to get lower and lower on cash. At the same time, during that due diligence process, I think they had a couple of concerns about us, and we also had a few real concerns about them, and so there was this kind of red flags coming up on both sides. And I think we could have, if we didn't have really good, strong investors behind us, I think we could have found ourselves really scrambling at the end to, when all of a sudden we sort of both decided that no, this wasn't a good fit. We were not going to sort of consummate the deal. If we weren't prepared for that, I think we could have then been, oh God, now we don't have much cash left. We've got to really rush and get desperate for another investor. But what we had done is all the way through, we kept our, the board was obviously watching us quite closely. We kept our original investor informed. And, again, they were happy to support us with another bridge round to sort of say, don't worry, if this does fall over, we'll put more in and back you. So we never had a scramble at the end, which was great. And for us, it was a really good lesson learned. And what we actually decided to do then, because of that learning, we actually then reached out to a US investor that we had built a relationship with, which was Greycroft, and we invited them to join us on and put in a small amount into the last bridge round so that they essentially joined our investor base, and they could then help guide us for when we reset and did our Series A round, which will be next year.
Yeah. Okay. That's great. That's a great story. No, it's really, this is what people have to understand, how fundraising actually happens. And sometimes it's messy, right?
The biggest thing I learned was, if someone had asked me, at the start of that, when we signed the term sheet, if someone had asked me, hey, Brent, how confident are you that this is going to close? I'm like, yeah, this is going to close. This is a done deal type thing. And it was only, I guess, through the wisdom of the board, through the process, when we did start seeing a few red flags, I was still quite bullish. It's like, yeah, no, don't worry. I'm comfortable about this, and it's going to close. But it's only my board said, no, let's just get plan B in place anyway. Even if we don't have to pull the trigger on it, let's just get our ducks in a row on plan B and have it sitting there on the shelf. And I think that's probably the best bit of advice I got during that time.
Great. So on that, when you're in due diligence with this first firm, was it an exclusive, or did you were in a locked into the term sheet there, right? So you could not really be shopping around, talking to other investors. Can you maybe talk on that a bit?
Yeah, correct. So I can't remember. So yes, we signed the term sheet with exclusivity, and one of the things that we did negotiate was the exclusivity period. So it wasn't open ended, and it couldn't go on forever. I can't remember the exact duration of it, but yeah, there was this exclusivity period, and so that did mean that even though a couple of red flags came up, we couldn't go out there and start engaging other investors or talk to anyone else about the deal. But because the process got dragged out, we ended up coming out of the exclusivity period, and we were still going through the negotiations. But it did mean that that's when we could at least, go out there and engage others if we needed to.
So do you wait until kind of calling off the deal to re-engage with other investors, or did you start it as soon as that exclusivity period ended?
Well, because our original investor has a seat on the board, we were having the discussions at board level, which meant our original investor was actually privy to those anyway. So we didn't have to go out. So what we did was we basically lined up the bridge round with our existing investor as plan B. And then once the exclusivity, and so we already had that in our pocket, if you want. And then once the exclusivity period finished, then we approached Greycroft and said, hey, here's what's going on. We're going to do this extra bridge round with our original investors. Do you want to come and join that on board? And they jumped in then.
Yeah, that makes sense. Great story. Let's talk about bridge rounds a little bit more for people who aren't familiar. So, share whatever numbers you're comfortable, but like, what's the typical amount of a bridge round? Is it like another $1 million each one? And are the terms the same as the first round, or do you kind of reprice or do different valuation at each bridge round? Maybe just a little color on that if you can.
Yeah. Sure. So we signed the original deal with our innovation fund, at a certain valuation and a certain set of terms, and then and kind of with a certain expected runway. We think this should get you the next 12 to 18 months. As we started getting close to that period, we then started opening up discussions with them again. We're going to need more funding. Do you guys want to fund us again? And they immediately said yes. So then it then came down to the terms of the bridge round. Now, the only thing that we kind of renegotiated was the valuation. So we didn't keep it at the original valuation. We said, all of the other terms remained the same, but we basically said, hey, look at our revenue growth, look at our customer growth, look at all of this sort of stuff. We think that we need to renegotiate the valuation. And we didn't go out and shop it or get super competitive, but they sort of said, no, we think that's fair and reasonable. Could we have got a higher valuation? Probably could, but it would have been another whole set of negotiations and things like that. And so I think there is a certain premium on keeping it really simple and keeping it really clean and not being too distracting in the process. So it was a pretty simple negotiation for jumping on the back of it.
Yeah, that's good. That's useful to know. There was a good post, I think it was yesterday, Jason Lemkin of SaaStr, I think, wrote it. And it was like questions that you should ask the VC kind of in those early days. And one of them was, paraphrasing here, would you do a bridge round if we need to, or would you follow on the next round? And kind of establishing that even before taking that initial money, I think is actually a pretty useful thing. Obviously, it's come in handy for you guys.
Yeah, it did. And I got to say, I do like that when a VC says, we don't want to give you more than you need right now, and we'd rather, just give you chunks as you need it, and we're there prepared to support you if you're hitting your sort of milestones. That is a nice, reassuring message to hear as a founder.
Yeah, and it's great. So on a couple other questions. On the structure, you guys are in Australia. Is it like here we have our normal priced round, equity round, or convertible note, or sometimes a safe? Are you different structures there, or what's the structure of the financing that you're actually doing?
So I think it's a pretty standard sort of equity round. We didn't do any convertible notes. We didn't do anything funky. It was pretty much just straight equity.
Got it. Okay. Okay, got it. And maybe let's go back to due diligence a little bit, because I think just go back to the story just for a minute or two, because I think due diligence is one of the most. I remember I actually thought I was getting an ulcer when we were going through due diligence. Anything you can share about like where your gut knew this was a bad deal, or some of the red flags to watch out for, just in maybe general terms if you want to. It's fine.
Yeah. So I think first of all, I think that the first red flag was the investor that we'd signed with. They were used to writing bigger checks and doing bigger deals, so we were right at the lower end of what they're used to. And I think the first sort of aha moment came when we got the due diligence request list from them, and it was kind of like it was multi-tab spreadsheet with like hundreds of request items in there. And I felt like right from the beginning, we were pretty buttoned up from a systems and a data and a process and a legal perspective. So I actually went into due diligence without too many worries. I thought, we've got our ducks in a row. But oh my God, the amount of analysis that they want, cut multiple different ways and things like that. That was the first sort of aha moment. The second was, they said, we'd like to reference check your customers. And I said, great, here's our customer list. I said, tell me who you want and I'll give you introductions. And so they said, we'll start with your top 10 customers. So I introduced them. And then all of a sudden I started getting customers calling me up saying, Brent, I just spoke to this investment company. And they said, oh my God, what a grilling that was. And I said, what do you mean? And they said, it was literally, it was a 90-minute call and it felt like an interrogation. Wow. Okay. And so to me, that was like, oh God, that's not good, and then I got a couple of customers it wasn't a complaint, but it was kind of almost like that was not a pleasant experience type thing. And then I remember my head of sales wanted to meet with them further. They wanted to meet my head of sales later on down the process. And he got out of a meeting and he said it was like a grilling. He said, there was 4 of them lined up. I was across the table from them, and he said, and they were going through my pipeline and my forecast, literally cell by cell, and they were challenging me on all sorts of things. He said it was probably one of the most unpleasant, uncomfortable meetings he's had. And again, from a cultural fit perspective, it's kind of like, hey, this doesn't feel well. So that was some of the red flags that we got from them, and also I think they got from us. And I think that I don't know whether they just felt that culturally we weren't a good fit for them.
No, that's great. I think those are important things to figure out up front.
Yeah.
You mentioned Greycroft they're the U.S., New York and L.A. I think, are they based?
Yes. New York and L.A.
They'll be kind of advising on, the future Series A. Have they started doing that yet? Have they started coaching or prepping you for that, or anything to take away from that?
Yeah, not really. So I actually, we've only closed around with them fairly recently. And in fact, I just met one of the guys in New York yesterday, and I'm meeting one of the partners in LA next week. But I think they're starting to. So what was interesting is I said to them, look, I'm taking my team for an offsite, and we're going to plan for our next fundraising round. What are we going to do with the funds? How fast should we grow? And what the whole plan's going to be. And I actually said to Greycroft, what parameters do you think I should set around this? Because I could go in there and I could say we can aim for 50% growth or 100% growth or 200% or whatever. What is a realistic but aggressive target that we should be setting ourselves, for a company of our size? And they gave me the target, and it took me a moment to sort of pull my chin up off the floor. But then I sort of sat down and went, oh my God, can we do that? Can we really grow that fast? And so I turned around to my head of sales and said, give me a back of the envelope analysis. If we want to take our ARR from this to this, can we do it? What would it look like in 12 months? And same with my marketing and same with my customer success. And what's interesting is what at first kind of made me think that was almost impossible. When you start looking at it that way, it's like, actually, this will be a real stretch for us, but I think we could actually do it. And let's build a real audacious business plan around this type of growth, and let's see if we can make it happen. And we'll probably build a fallback plan, which is plan B if things don't go the way we think. But so Greycroft have been focused helping us to think through that. And then the next step is then going to be, once we run all the numbers and do all the plan around that and what sort of capital we need, I think that's when they'll guide us then into, okay, what does Series A look like? How much are we going to ask for? Who are the right partners? Are they going to lead it or participate? That type of thing.
Good. Yeah, that's valuable coaching. Anything that you can share, or just general benchmarks that startups should be thinking about for Series A? Kind of like, we need at least 3 million in revenue, or any general benchmarks there?
So what I've heard on sort of the guidance that I've had from talking to a lot of investors is that for around the Series A level, you should be sort of somewhere in the 2.5 to 4 million of revenue, we'll certainly be right in that sweet spot. It's really clear that there is this ideal sort of perfect sort of company that investors are looking at, and they're kind of looking at certain metrics. What's your ARR? What's your burn rate? How long you've been going? What's your growth rate? And but that seems to be the sweet spot when it comes to ARR.
What about growth rate? Do they give any, or do you have any sense for monthly revenue growth rate that a Series A should be? Right.
Well, it kind of when you're small, it's easier to grow fast, right? It's easy to go from $1,000 to $3,000, $4,000. That's easy. We sort of we're going to be aiming for 200% growth. So we want to triple our revenue in the next year.
Annual growth rate.
Annual growth rate, yeah. That's what we're going for, and it's not going to be easy, but that's certainly what we're going to try and engineer for.
Yeah. Okay. Well, we've covered a lot of good stuff. Anything you would do differently if you would do this all over again? Any kind of mistakes or, big lessons learned, or have we covered it all?
No, I think we've covered the main one. I can't emphasize enough about the cultural fit of the investor. So when I go into an investor and they say, what type of partner you're looking for, I have a pretty clear answer. I say, number one, I'm looking for, the first thing is cultural fit. And it may sound kind of weird, but I love my board. I really enjoy my board, and I actually look forward to board meetings, which may be a weird thing for someone. I've got a small board, it's myself and 2 others right now, with 2 observers on the board as well. But I want to make sure that if I have an investor who's now got a seat on the board, I want to still keep that dynamic of really enjoying the board meeting and having good, challenging discussions and debates around things. But I don't want to have to dread walking into a board meeting thinking, oh my God, I got to get through this. Mm-hmm. That's number one. And the second key thing I'm looking for is just the experience of the VCs. If we're going to put the accelerator down and we're really going to try and do 200% growth, we're going to stress test the whole, almost every aspect of the company. I want someone that's going to help us steer us around as many potholes as possible.
Yeah, good. All right, last question. You'll be looking to do a Series A. When did you say next year sometime, right?
Yeah, probably Q2 next year.
And what are your thoughts on that? Will you be coming to the U.S. or will you be sticking to Australia, or how do you think of it in a global context? Yeah.
We'll definitely be coming to the US. I think that I view Australia as a really good sort of incubator, and it's a great place to sort of start to grow. But then if you really want to, get serious and sort of play with the big boys, I think it's the US market. There's so much experience and expertise here, and I think that you just don't get that same sort of expertise from your investors in Australia. So I think starting in Australia, but then leveraging some people that have just done it so many times before is what we're really after.
Cool. Great. All right. Well, very good. If people want to learn more, it's enboarder.com, right?
Enboarder.com. Yep.
ENBOARDR.com.
Correct. And happy to take, they can reach out to me, Brent@enboarder.com.
Super. Anything you want to plug or promote? Any deals? Black Friday. What is today? Today's Cyber Monday, or I guess Cyber Monday was yesterday. Anything? Or 2 days ago. Anything you want to plug, or any promotions, or any open jobs you want to talk about, or?
Well, yeah. So first of all, we're going to be growing like crazy once we get our Series A. But the other thing I'd say is, onboarding. It's one of the things that's kept me awake most at night is as we grow as a company, how do I keep the culture as I scale? And as we start sort of doubling or tripling the company, I want to make sure that my workforce is as good as it is today. Doesn't matter how fast I grow. So we eat our own dog food. We make sure that we onboard all of our staff and really select the best staff and give them the most amazing experience when they join the company, so that, they go around to their friends and just saying, I just joined Enboarder. That's amazing. And so any of the other startups that are listening, if you've just got funding and you're growing, don't forget about the onboarding.
Perfect. Yes. Very good. Well done plug, by the way, too. All right, this is great. Well, we'll catch you after that Series A. I want to hear how that goes. That'll be our next juncture. So thank you very much. Enjoy the rest of your time in the US.
Thanks very much, Nathan. Thanks for having me, and thanks for your time.
Cheers.
Bye.